Joining us now, Sharmin Mossavar-Rahmani, Goldman Sachs Chief Investment Officer of Private Wealth Management. What do you think? I mean, are you similar thinking, or do you need to manage risk in a way that it's more front and center, and there's been big gains already?
We've actually had the theme of staying invested now for over 10 years. So when we started during the global financial crisis recommending our clients actually go overweight, we have never since suggested clients actually reduce their exposure. So let's start with the premise that clients have a good customized strategic asset allocation, the right mix between stocks and bonds and other assets. We have actually never once recommended clients go underweight. So we have actually been long equities this entire nearly 11 years, up 500%. In addition, we've also recommended clients have a much bigger allocation to U.S. equities. So the theme of stay invested, but also the theme of American preeminence. We've said relative to both developed as well as emerging market countries, U.S. is preeminent, so clients should have a much bigger allocation actually to U.S. equities and be underweight emerging market and other developed equity markets.
Once everyone has this opinion, now, is there a time when you say, okay, we've ridden the horse long enough, or do you know whether we're getting close to that at this point, to use Tepper's?
There are two factors that we focus on, one of which is if we're in an expansion, the odds of a positive return is 87%. So one definitely has a huge tailwind in terms of the current economic environment, and we have a low probability of recession. So that would encourage us to continue to stay invested. The American preeminence theme, we also think, is a long-lived factor. It's not something that's going to disappear, whether it's competitiveness, productivity, innovation, rule of law. We can go through labor productivity. There are just so many factors, demographics. So we think these two themes have staying power. That's actually the title of our outlook, which is on our website, Room to Grow. So we actually, again, believe that there's more running to go, to use their expression of this horse. We also don't think equities are very expensive. They are slightly overvalued. By our metrics, they're overvalued by about 13%. That's not enough to start going underweight equities. And we're also very sensitive to taxes for our clients. If you had $1 invested at the trough of the equity market and you had not sold that, the equity market has to go down, if you're a New York City resident, for example, 29% just to make up for the taxes. So I think the idea of trying to get in and out of the market for short-term trading is not beneficial because the tax drag is going to be huge.
Right.
So economic expansion, and we have to see much higher valuations to actually recommend getting out of the market.
Thank you. Thank you for I feel like we've heard a lot of voices today, and that's another good one. Thank you, Sharmin.